Good morning, Jags. This is Fahad. Today is Wednesday, December 16th. Let's get started. The chart that's in front of you is a mortgage services insurance provider or mortgage insurance provider, NMI Holding, symbol NMIH. Now, we have never covered this before. It usually doesn't pop on my screen, on my scanners. But yesterday, we saw something interesting. Chart has been consolidating in a very, very tight range after a high volume surge back in September. It's been doing so for the past 2 months, with $25 acting as an important layer of resistance, and the downside has been around, support has been around $22 per share. Yesterday, somebody, right after the market opened, they started buying these January 25 call options. It ended up trading 68 times daily average call volume yesterday, with an implied volatility shooting sharply higher. And they were mostly paying 70 cents for these January 25 calls. All morning long and also in the afternoon, they were active. And this morning, when you look at the option chain, you can see that 2,000 of these calls are now positioned in the open interest in the January 25 strike. Here's another technical look on the chart. If you look closely, you can see that $24.50 is a major VOP resistance. The stock has come up to that level multiple times in the past 2.5 months, but each time it failed to break out. And this was after a strong surge in late September and early October on rather heavy volume. So this nice consolidation continues to take place while the MACD and the RSI levels have corrected back to a neutral state, flat line, and potentially triggering a new breakout, a new improving momentum indicator right here. If you look at the MACD line, is starting to rise and such. So let's see if this will start to clear 2450. And the bulls are positioning for that breakout with approximately $150,000 worth of calls bought on this yesterday at the January 25 strike. Now, with all of this said, some background is necessary on this company. This is a $2 billion company that for the 9 months ending September 30th, it posted a total revenue growth of 22% year over year. Naturally, with a strong demand for housing, low inventory level, low interest rate environment, all of that has been a boon for mortgage service insurance providers, and that's been the case over here. But also on November 20th, this company held a virtual analyst day in which they provided some new tidbits that were not available to us when the company reported its earnings in early November. Some of those tidbits highlight that the company continues to enjoy a very strong Q4 that should continue well into 2021 as well. So for example, here's a key highlight that comes from RBC Capital, in which they mentioned that the mortgage insurance industry is seeing a record new insurance written volumes, the policy volumes that is, in 2020. NMI estimates that by year end, the industry will have written $575 billion in total NIW versus the previous record of record year below 400 billion. Why is that important? I do a simple math around this. If I take 575 minus 400 divided by 400, it comes to a growth rate of 43% year over year. But the company during the first 9 months of 2020 posted a growth rate of 22% year over year. If we go with the belief that the company is actually performing neck to neck in line with the market expectations or the industry growth estimates, this is basically a hint that the growth rate is potentially accelerating in the fourth quarter, and they're going to finish the fourth quarter much stronger on top of already what has been a very strong year for the company. And that's a hint for the upcoming earnings report for the fourth quarter, which will be sometime in late January or early February. So that's the first point. The second point that they mentioned in this virtual analyst day on November 20th was the emergence of digital mortgage system, which is starting to play a very strong and a high margin business platform for the company. So it's starting to play a very important part in the company's growth aspects. So for example, they mentioned that 95% of its NIW volume through its Rate GPS product has now reduced the number of touch points that are needed to connect with the customer, and between its sales process and therefore the entire process has been streamlined. They now have more than 1,100 agreements in place. One of the biggest agreements was actually also signed in the fourth quarter, sometime in late October, with the original loan originators. I'll talk about this in just a minute. And and they have also added 87 new agreements this year, including 23 in the top 600 lenders. The company has reached agreement with 58 new customers just since April. So this is also telling you that with these partnerships and the deal signings with the digital sales platform, they continue to build that out, and they continue to be a provider of this key service at a time of COVID. Now, another important thing that they mentioned was that they signed this major agreement with a company called Loan Originator Networks, also goes by symbol LON. And this company, with this agreement, they expect to integrate their company's Rate GPS product to mortgage lenders' loan origination systems. And this will be one of the biggest agreements that the company has signed. This went into effect on November 12th, I believe, either November 10th or November 12th, sometime around that. So the benefits of this will start to appear immediately in the fourth quarter. This is not in consensus view because the company posted this earnings report. They didn't talk about this, and that was on November 5th. So I expect that to become a strong tailwind for the company as well when they report the next earnings. And then just one last point about this. The company also indicated that they're taking a conservative approach given the COVID-19 loans are still elevated in terms of their default rates, but they do believe that any kind of congressional policy that comes out, and we know that Pelosi and Pelosi and Mnuchin continue to hammer out the detail as to what kind of next fiscal policy will come out. But there's a chance that in this policy there could be new programs embedded that for the forbearance that will help the struggling Americans in terms of their loan defaults as the crisis for COVID-19 continues to go on. And if that happens, that will be naturally positive for the company because that will keep a lid on default risk rising any further than how it is already. And arguably, if COVID goes away next year sometime with the vaccines being distributed and the loan default rate continues to come down gradually with improving employment situation in the country, we would expect the book balance or the book value for this company to improve as well, which will also be positive for the stock. So these are the biggest key takeaways. First time covering this one. It looks very appetizing. Look for a breakout in this one through $24.50. And if it do so, there's just one last thing on this one. It's worth mentioning because there is a big air pocket technically on the stock. So if it clears through all of this, you can see there's a big air pocket that can carry the stock all the way to $29 per share. So these calls are not expensive. These January call options are currently going for 70 cents to $1 because they will make a ton of money if the stock gets to $29 per share, where it will meet minor resistance. And after that, the next layer of resistance comes in around $32 per share. So on a percentage basis, there could be as much as 20 to 30% upside coming. That's it from me. Jay.
Morning, everyone. So I have two stocks today, and both of these will be featured on the homepage. The first stock, which will be published later today, is Monolithic Power Systems, ticker MPWR. The last time we covered this name was July 16th, and that was also a homepage write-up. At the time, the stock was trading $246, now trading at $331, so a decent move. Within that write-up, I talked about the opportunities that the company was seeing relating to Wi-Fi 6 adoption, next-gen console ramps, so plenty of opportunities. I think I mentioned endless opportunities. Now there was a recent note on Monday from Needham where they met with the CEO, CFO, and a number of topics were discussed, from order patterns to Huawei to a new 12-inch fab coming online. So needless to say, I will provide another update on the homepage later today.
Yeah, looking forward to it. This has been, I was positioned in this stock after that article you posted back in July. I did make a pretty handsome amount of money on this one, trading some call options because the momentum was so strong back then, right? You can see that before that correction happened, which didn't happen until all the way down, until all the way September. So between that time when the article was published in July until August, this stock went straight up like $60 in a very healthy, strong move with no resistance. So it was a lot of money to be made there. And then I missed this move that happened rather far more rapidly back in September. But nice to see this thing has been consolidating for about 2.5 months now. And it looks like, look at the surge in the volume that we saw in the last couple of days. This thing is trying to break out from this range again. So I'm looking forward to what you have, what kind of new tidbits you have in your upcoming article on the homepage.
Definitely. And then the second stock is Cooper Companies. Now this homepage write-up will most likely be published tomorrow, but this is certainly a longer term outlook anyway. For those that do not know, this is a medical device company, and I actually covered this last on August 9th in the Weekend Research. At that time, stock was trading 303. It did run up to as high as 364 in October, but has since pulled back. Their largest segment is called Cooper Vision, where they are a leading manufacturer of contact lenses. If we go back to November of 2019, the FDA approved the first contact lens indicated to slow the progression of myopia in children between the ages of 8 and 12. This is called the MiSight contact lens. In their last earnings report, they indicated that MiSight sales grew 73% to just 2.5 million. But looking out for the next year, 2021, they're looking to see that growth go up 250%. Now, one of the things that I will showcase is some channel checks from Stifel analyst Jonathan Block, who, I've mentioned his name before. He covers the animal health space. So Zoetis, IDEX, he covers Align Technology. His notes are always very detailed. And what he was doing in his recent note, he looked to Canada as a leading indicator because MiSight rolled out in Canada in the first half of 2018. And what he did, he spoke to Canadian optometrists, when it first started to roll out. And then the last time he had covered it was in December of 2019. And so then he followed up again, and that's sort of what this note is all about. And so he's using Canada as an indicator to see what type of growth MiSight is going to have here in the United States as now it finally starts to ramp. So I will have as I said, a nice detailed write-up on this name probably tomorrow on the homepage.
This would also be very interesting, and I will just even go ahead and say that it's precisely because it's Jonathan Block, and he has a tremendous reputation in following this industry, and particularly Align Tech and some of the other medtech companies. This article that you had previously published on Cooper Companies on August 9th in the Weekend Research, this has been phenomenal run since then too, and just like a lot of the other momentum names, this has consolidated recently. So back then, when this article was published, the stock was at 303, and then this happened. So very timely article back then. And if you look at that time too, the entry was phenomenal, where here is the downtrending resistance. The stock started to break out just in time when that bullish article was published in the Weekend Research, and then in just a couple of weeks following that, the stock went straight up from 303 all the way to 350, running by 15 to 20% to the upside, and then moving higher even more. But the last 2 months has been just dead money. So sure, it's probably going to consolidate here, and this is to be very much expected. A really good company, and I would expect another breakout. So looking forward to what you discover from the Canadian operations in terms of the channel checks. Should
Definitely.
be a fun one. All right, great. Chronicle.
Morning. So on Monday, I talked about 3 of the themes that I foresee to take place next year. Today I'm going to talk about the fourth one, which is the very high possibility that 5G performance in the US could turn out to be very disappointing in the medium term. Now, I know a lot of people are bullish on 5G, including myself, but so let me explain what I mean. So I've been talking to friends living in countries with 5G, and what they've been telling me with regards to 5G is that it's not great so far, though they were less more colorful in their language, but basically they're experiencing a lot of speed inconsistency issues and also frequent disruptions in their service, and they're disappointed. And I don't think this is just anecdotal, because if we look at the regional news articles of 5G, like for example, in South Korea, now if we remember, they began 5G service in April 2019, and I have this article here, which is from last month, and apparently lots of people there are now canceling their 5G contracts out of frustration, and now the big three telcos there are finding out that they need to spend another $22 billion over the next year to fix these problems. And then next to that, if we look at China, they launched 5G in September last year, and it's pretty much the same story there. Slow speeds with plenty of disruption and more investments to come. So that's Asia. Now looking at the US, the 5G build out in America doesn't look like it's going well either. Like we can see here, on top of all the problems with signal interference, the 5G speed in the US is currently much slower compared to a lot of other countries as well. In fact, the speed that's experienced is actually often slower than 4G. Now, I remember back when I was studying computer engineering and during my undergrad, this was several years ago, I had this professor from my communications networking class, and he would often take the chance to remind everybody in lectures that he thought the direction that the industry was planning to take with 5G architecture, they were going about it the wrong way. And he would often tell the class, mark my words, this is not going to work properly if the industry R&D continues down this direction. So I have to give him credit, because as it turns out, it's not working correctly so far. And the major reason for this disappointment, and this is getting a bit technical, but it's basically because the current 5G architecture forces engineers to make a very costly trade-off between several things, chiefly of which is the channel size and the proximity of antennas. That's the simplest way I can put it. And what makes it worse in the US is that millimeter waves are not great in performance when it comes to wall penetration and travel distance. So the implementation of waves is a big part of the drawback, especially for Verizon, which uses that method. So when I put everything I just said together, what this tells me is that 5G is very likely going to be a letdown in 2021. Listening to this, you might think that I'm being bearish on the sector, but I'm actually cautiously bullish. Because if we think about this, we have governments and corporations around the world who have already committed to this, regardless of whether it was a mistake. So they're not going to backtrack. Instead, I think they're going to double down and throw more money at the problem. And so what I think this ultimately means is more spending on base stations, more spending on equipment, and more spending on field testing than what consensus has factored in. So it's not bearish, it's bullish, because I don't think the amount of extra work that needs to be done to get all of this working correctly has not been fully baked into consensus numbers. Like when I'm reading analyst notes and financial research on 5G, I'm finding many of them are operating and modeling numbers on this assumption that we're going to build out 5G with few major hiccups. Personally, I'm not buying this assumption. I think there's going to be a lot of growing pains and a lot of trial and error with regards to this build out. And I think the industry knows this, but they're just choosing to keep quiet because, and they're using a lot of, vague language to get around it to entice customers. So I guess my main takeaway here is that there is going to be a lot of unforeseen additional budgeting and capex that will be needed for 5G, which hasn't been factored in. But whether or not we're going to have the budget for it, that's something we're going to have to watch with regards to the Biden administration, because once they do an appraisal, I think they're going to be surprised by the amount of additional investment it's going to take to get everything to work perfectly. Like if they don't allocate enough money to this, it could end up taking several years to complete the rollout. I know Biden has promised $300 billion in R&D for new technologies, but the question is how much of that will go to 5G. This is something to watch. And then lastly, there's going to be a lot of disappointed 5G smartphone customers as well. So we might see a bit of a slowdown in phone sales because all these problems, disruptions and inferior speed, like if we're putting aside the hardcore fanatics of Apple and Samsung who are always going to buy a new phone year in, year out regardless, if we put aside that crowd and just look at rational people, I think many are going to be put off from purchasing a 5G phone the longer these problems persist, because not everybody is going to tolerate this lousy service. So putting everything together, this is theme 4 from the thought exercise, and I'll touch on my 5th and final one next time.
This is quite a contrarian view, I have to say, Chronicle, even though you're not outright going bearish on the industry. You are presenting a more of a cautiously bullish view where basically you're asserting the case that that there's a bit more hyperbole currently in the sentiment than perhaps it should be, because the infrastructure is not supporting the speed that was promised by this important technology of 5G, and so that means more capex will be needed for us to get there. And without significant amount of capex, which should naturally be bullish for the key component makers and suppliers and the infrastructure makers, but without it, it could take far more years than people had anticipated. But this is generally speaking towards the like, especially if people are going to be disappointed on the Apple, for example. I mean, it was just yesterday that Apple raised its guidance and told the suppliers from Asia to increase production to which is now expected to be 30% year over year, right? I mean, and all because of the potentially surge in the 5G demand for the new iPhone that just came out. So they're telling suppliers to increase the production for it. So this view is quite contrarian. That's my first thought from this discussion. And the second thing is that if there is going to be significant more amount of capex, and particularly for base stations, that's bullish for MRVL. A MRVL, that means the total amount of capex cycle, which was supposed to last 1 to 3 years, could potentially be, and we're already in the second year of that, could potentially last as long as 5 years for MRVL. So the outlook for the company improves even further and longer for a base station maker such as MRVL, based on this discussion. And the second thing would be, then one of the comments that I heard from you was that the density needs to be better for the service to be faster, for the signal service to be as fast as the industry has promised. And the way you get there is by increasing capex for small cells deployment, and those small cells are produced by companies like CCI. It is the absolute leader in that. Crown Castle, that is. It has been our favorite in the past as well. And so this would be positive for this company too, because I mean, if in states like in cities like dense populated cities like New York City, urban population, they've been deploying these small cells like literally every 30, 40 feet apart in buildings and trees and electric poles and wherever, to create as dense of a network as possible for 5G to work properly. So those would be my biggest takeaways in terms of actually calling shots as to which stock would benefit from this particular view. Just my quick thoughts on this. Do you have any final words?
No, I completely agree with everything you just said. So what the Biden administration does, how much money they allocate, this is a very important thing to watch.
Okay, sounds good. All right, folks, we're going to stop over here. Thank you very much for joining. We'll see you in the chat room shortly.